Two people, same age, same city, same job, same paycheck. Marcus and Kevin. Both 22. Both pulling in about 45 grand a year. Both feeling broke the same way you feel broke at 22. Like there is never quite enough. Like the adult version of comfort is always somewhere in the future. One Tuesday afternoon in October of 2024, Marcus opened a brokerage account on his phone. Set up an automatic transfer. $100 a month. He did not feel heroic doing it. He barely noticed. He went back to watching YouTube. Kevin spent his 100 the way most people spend money at 22. Streaming services he forgot he had. Uber Eats 3 times that week. A pair of shoes he thought about for 2 weeks and then bought. Nothing reckless, just normal life. That was the entire difference. Fast forward 30 years. Marcus is 52. His investment account has $226,000 in it. He never missed the $100. It just grew. Kevin is also 52. He never started. He planned to when he got his next raise, after he paid down his car, when things settled down. Things never quite settled down. He has the subscriptions, the meals, the shoes, all consumed, all gone. 52, starting from 0. The difference between them is not talent. It is not luck. It is not a raise or a windfall or a rich uncle. It is one decision made on a Tuesday afternoon in 2024 that Marcus made and Kevin did not. That is what this video is about. Not investment theory, not finance jargon. What actually happens, the real numbers, decade by decade, when a regular person puts $100 a month into the market and does not stop. Let me show you the math first, because the math is the part that changes how you see this. $100 a month, $1,200 a year. Over 30 years, you contribute $36,000 out of your own pocket. That is your real number, $36,000. That is what you actually sacrifice. Now here is what the market hands you back. The S&P 500, the index that tracks the 500 largest American companies, has returned roughly 10% per year on average going back to 1926. Not every year is 10%. Some years it is up 30, some years it is down 40. But the long-run average, compounded, with dividends reinvested, comes out to approximately 10% nominal per year. That number is not cherry-picked. It is almost 100 years of data. At 10% average annual return, your $100 a month becomes $226,000 after 30 years. Not an estimate. That is the future value of a monthly annuity at 10% compounded monthly. The math is precise. You put in $36,000. The market gives you back $226,000. That is 6.3 times your money. You did not work 6 times harder. The math worked 6 times harder. That is the entire game. Now, if you want to be conservative, strip out inflation. The real inflation-adjusted return on the S&P 500 is roughly 7% per year. At 7%, your $100 a month becomes $122,000. Still 3.4 times what you put in. Still $122,000 you would not otherwise have. And if you get aggressive, if the next 3 decades run hot, at 12%, that same $100 a month becomes $349,000. Same person, same $100, just a different slope on the compound curve. Stop and think about what that means. The spread between conservative and aggressive outcomes is over $200,000. The only input that changes is the rate of return. The discipline, the $100 every month for 30 years, is identical in every scenario. The discipline is more important than the rate. You put in $36,000. The market gives you back 6 times that. That is not a trick. That is not a loophole. That is math working for you instead of against you. In this video, we are going to break down exactly what happens to your money decade by decade. We are going to look at what most people get wrong about small amounts. We are going to cover the one account that makes that same $100 worth significantly more without any extra effort on your part. And we are going to look at the most important comparison in personal finance. What happens when you start at 22 versus 32 versus 42, and why the gap is wider than you think. Before we get into it, one side says $100 a month is too small to matter. You need to earn more first. $100 is a rounding error on a real investing strategy. The other side says $100 a month is exactly how most real wealth in this country actually got built. Not in big lumps, not from windfalls. Month by month, automatically, over time. Drop your answer in the comments. This argument is older than the stock market, and it never gets settled. I want to know which side you are on. Now let us walk through what actually happens over those 30 years. Because the numbers, decade by decade, tell a story that a single final figure cannot. Years 1 through 10. You invest $1,200 a year. By the end of year 10, you have put in $12,000 total. At a 10% average annual return, you have approximately $20,500. That means the market added about $8,500 on top of what you put in. That sounds decent. It does not feel like a transformation. Here is where most people quit. Year 10, they look at the account. They see $20,000. They have been doing this for a decade. They think, this is not working. I should use it for something else. Or they stop the automatic transfer because money got tight and never turn it back on. But here is what they are missing. That $20,000 is not just sitting there. It is compounding. Every dollar in that account is earning 10% a year, and those returns are buying more shares, which earn more returns. The first decade is the hardest because nothing feels like it is working. It is, you just cannot see it yet. The tree looks like a stick for a long time before it starts to look like a tree. Years 11 through 20. You add another $12,000, $24,000 total out of pocket. But watch what happens to the balance. It goes from $20,500 to $75,900. The market added roughly $55,000 in the second decade, more than 6 times what it added in the first. That is the compound curve starting to show its shape. The returns are not bigger because you did anything differently. They are bigger because the base is bigger. A 10% return on $20,000 is $2,000. A 10% return on $75,000 is $7,500. Same rate, bigger pile, bigger return. Here is the moment I want you to notice. Sometime around year 8, the math crosses a line. Your account balance hits roughly $12,000. 10% of $12,000 is $1,200. You are contributing $1,200 a year. At that point, your investment returns in a single year equal everything you are putting in. The market is matching your contributions dollar for dollar. By year 12, it is outpacing them. In year 15, your balance sits at about $41,000. The market's return on that balance alone, at 10%, is over $4,000 that year. You put in $1,200. The market put in $4,000. You are no longer the primary contributor to your own account. The money is doing more work than you are. That is the moment everything changes. Years 21 through 30. The final $12,000 out of pocket. Total contributed, $36,000. And the balance goes from $75,900 to $226,000. In the last decade alone, your account grew by $150,000. You put in $12,000 in that decade. The market added $150,000. The last decade does more work than the first two combined. This is why everyone who talks about investing comes back to the same word: time. Time is the asset that no amount of money can buy back. And that $150,000 the market added in the final decade is more than 4 times everything you ever invested over the entire 30 years. The math in the last 10 years is not just helpful, it is doing the heavy lifting for the entire 30-year run. Now let us talk about the account, because this is where most people leave serious money on the table without knowing it. If you put your $100 a month into a standard taxable brokerage account, the government takes a share of your gains when you eventually sell. Long-term capital gains, assets held more than a year, are taxed at 15% for most people. So on $226,000 at exit, the IRS takes roughly $28,000 of your gains at the 15% rate. You walk out with about $197,000 instead of $226,000. That is $28,000. Gone. For doing the same thing for 30 years with the same discipline at the same return rate. There is an account built to solve exactly this. It is called a Roth IRA. You contribute money you have already paid income tax on, and then every dollar of growth, every compounded return, every dividend, every share price gain, comes out in retirement completely tax-free. Not tax-deferred, tax-free. At $100 a month, you are investing $1,200 per year. The 2024 Roth IRA contribution limit is $7,000 a year. You are not even close to the ceiling. You have $5,800 of additional headroom per year. At 30 years, the Roth IRA gives you the full $226,000 with no taxes owed on exit. The taxable account gives you roughly $197,000 after taxes. The Roth advantage is around $28,000 to $40,000 depending on your bracket. On the same $100 monthly investment, with no additional work. The government built this account to encourage retirement saving. They are handing you a free multiplier. It is not a loophole. It is not for rich people. It is for anyone with earned income under the income phase-out thresholds. For most people watching this, you qualify. Opening one takes about 15 minutes. Fidelity, Vanguard, Schwab, all of them have zero minimums on Roth IRAs. You go to the website, open the account, link your bank, set up the automatic monthly contribution, pick a broad index fund, and then you let it run. The difference between having a Roth IRA and not having one, for the exact same $100 monthly investment, is $30,000 to $40,000 over 30 years. That takes 15 minutes to unlock. Tell me in the comments, are you currently investing anything, even $50 a month? And if you are not, what is the actual reason? Not the excuse, the real reason. Because I have had this conversation with a lot of people, and the real reason is almost never what they lead with. And the answer to that question is usually more interesting than anything I can say in this video. Now here is the comparison that matters most, the one I want you to really sit with, because the numbers are stark in a way that is hard to forget once you have seen them. 3 people. Same $100 monthly investment. Same 10% average return. Different starting ages. Person 1 starts at 22. They invest until 52. 30 years of contributions. $36,000 out of pocket. At 52, they have $226,000. Person 2 starts at 32. They also invest until 62, also 30 years of contributions. Same $36,000 out of pocket. At 62, they also have $226,000. On the surface, that looks the same, but person 2 is 62 when they hit that number. Person 1 was 52. Person 1 has 10 more years of compounding ahead of them, which takes that $226,000 to somewhere around $580,000 by 62. Same amount invested, same rate, just 10 more years. Starting a decade earlier did not just give them a head start, it gave them a completely different destination. Now here is where it gets real. Person 3 wants to reach $226,000 by retirement age and starts at 42. At 10% per year, they need 30 years to get there. That takes them to 72. Most people cannot or will not work until 72. The math still works, but the finish line moves to a place that is uncomfortable to acknowledge. But the most important comparison is not between these three. It is this one. Take person 1. They start at 22, but at 32, life gets complicated. A kid, higher rent, they stop the automatic transfer. They invested for exactly 10 years, $12,000 total, and then nothing. The money just sits in the account for the next 30 years, growing. At 62, person 1, who stopped investing at 32, who only put in $12,000, who gave up after 10 years, has $406,000. Person 2 invested every single month from 32 to 62 without missing once. $36,000 invested. Real discipline. Never quit. They have $226,000 at 62. Person 1 beats person 2 by $180,000. And person 1 invested $24,000 less. Read that again. The person who contributed less, who quit after 10 years, ends up with 80% more money than the person who contributed consistently for 3 full decades starting a decade later. That is not a quirk. That is the entire point of the math. The money that has been working for 40 years beats the money that has been working for 30. Every time. No exceptions. The time advantage is so powerful that it overwhelms 3 times the contributed capital. This is why starting early is not a motivational platitude. It is a quantitative fact. 10 years of early advantage turns $12,000 into $406,000. The same 10 years of delay costs you permanently, regardless of how disciplined you are afterward. Here is the other thing, the part nobody tells you. Most people have a reason they have not started, and most of those reasons sound rational. Some are actually valid. Some are quietly costing people hundreds of thousands of dollars. The first one, I will start when I earn more. The problem is, lifestyle inflates with income. When you are making $45,000, you spend $44. When you are making $75,000, you spend $74. The people who wait until they earn more mostly just spend more when they earn more. The investing habit has to be built at the current income level. Otherwise, it never gets built. $100 a month at 22 beats $200 a month at 32. The math already showed you that. The second one. The market is too risky right now. Every single year, for the past century, someone has made a plausible case that now is a bad time. There is always a war, an election, a rate decision, a banking crisis, something. The people who waited for a safe entry point missed some of the best years in market history. Rebounds after scary periods are often where the biggest returns live. Time in the market beats timing the market. That is not an opinion. It is what 100 years of data shows. The third one. $100 is not enough to open an account. This was partially true 10 years ago. It is not true now. Fidelity has 0 account minimums. You can open a Roth IRA with nothing and start in fractional shares. If you have a phone and a bank account, you can open an investment account today. The fourth one, and this one has real nuance. I need to pay off my debt first. Sometimes this is correct. High-interest debt, credit cards at 20%, mathematically deserves priority over investing at 10%. Pay those off first. But if your debt is low interest, a car loan at 5%, a student loan at 4%, the market's 10% expected return beats what you are paying. The line is roughly 10%. Above that, attack the debt. Below that, you can do both. Now let us talk about what waiting actually costs. Because most people treat it as neutral. I will get to it soon. Soon is not a number. The cost of not starting has a precise dollar amount. Every year you wait, you lose 1 year of compounding on your entire future stack. Not just 1 month's contribution. The growth that contribution would have generated compounded forward across every remaining year. Here is the concrete number. If you delay 1 year, 30 years of investing becomes 29. You do not end up $1,200 short. You end up $22,564 short. 1 year of delay on a $100 monthly investment costs you over $22,000 in final value. 2 years cost nearly $43,000. 6 months costs roughly $11,000. These are outcome-altering numbers, not rounding errors. And here is what makes waiting different from other financial mistakes. Most mistakes can be corrected. Overspend 1 month, cut back the next. Wrong stock, rebalance. Waiting cannot be corrected. Once the year is gone, the compounding that would have happened in that year is gone. You cannot buy it back. Waiting is not neutral. Waiting is a decision that has a price. Most people just never see the invoice. You now know exactly what $100 a month does over 30 years. 226,000 from 36,000 contributed. Slow and invisible in the first decade, snowballing in the second, explosive in the third. The last decade alone adds more than 4 times your total lifetime contributions. A Roth IRA captures $30,000 to $40,000 more from the same investment by eliminating the tax bill most people forget to factor in. And starting at 22 and stopping at 32 beats starting at 32 and never stopping. 406,000 versus 226,000, $24,000 less invested, 80% more money at the end. None of this is complicated. None of it requires expertise or a big income. It requires one thing: starting. The question is not whether this works. It demonstrably does. The question is not whether you have enough to begin. 0 minimum at Fidelity, linked bank account, 15 minutes. The question is whether you are going to start this month or find a reason to start next month. That is the only variable left. And most people find the reason: the car repair, the unexpected bill, the one more thing that makes this month the wrong month. Next month has its own version, and the months compound the same way money does, except in this case, they are compounding against you. One side says this is simple and anyone can do it. Set up the account, automate the contribution, leave it alone. The barrier is behavioral, not financial. The other side says real life, actual debt loads, actual emergencies, actual wages that do not cover actual expenses, makes this genuinely impossible for most people. And framing it as a behavior problem ignores structural reality. Right where you stand, because both sides have more truth in them than either usually admits. If you want to see what happens when you scale this up, what $500 a month looks like over 30 years, the specific moment when your portfolio starts generating more in a year than your job does, and the calculation for when investment income crosses earned income, that breakdown is next.